Welcome to the session of Incipient Institute. Today we are going to talk about NPV and IRR, which is internal rate of return. These two numbers and ratios are very, very important for any financial decision making in any type of corporate structure. Someone working in the financial accounting, corporate finance, budgeting, and various kind of investment activities, they are going to use this on regular basis. So it is a very, very popular number, both for the real life and exam purpose. So let's walk through these two numbers, understand the real implication, its meaning, and how the numbers are calculated, what are the objective of using those number and adjustments. So let's walk through the PV, the discount factor, NPV, and finally we'll talk about IRR, how it is calculated. So here we are going to use this one for financial decision making. And the first thing, when it comes to NPV, we find out the appropriate discount rate, which is called cost, which can be cost of capital, weighted average cost of capital, or any appropriate rate to which the business is exposed to. So if the business is going to borrow from bank and bank is going to charge 10%, we'll take that number, or any cost of capital for the company, that will be the standard discount rate. So here we are taking say 20% of discount rate, okay, in this example. So what the present value means is that if we are going to get $1 million in future, say in 10 years time, it will not be same in value in today. It will be much, much lesser if we use a higher discount rate, 20%. So, suppose, for example, if we use 20% discount rate, and for 10 years, 1 million will be worth almost, say, 0.4 million now. However, if we were to use only 10% discount rate, 1 million might be worth 0.7 million in today's term, because higher the discount rate, lower the value in the present in the present time. So with this, we can see discount rate is going to reduce the value and worth of the cash flow in today's term. And let's look at some of the numbers. And the same is true in the opposite direction. So present value today, and if we leave or apply certain in rate of interest, in some time it will be a future value, and that will be, again, after compounding, that will become bigger and bigger. Longer the time passes and bigger the interest rate or discount rate, it will be bigger in the future. So it works both way. We can calculate using the rate of interest or cost of capital. We can calculate future value from present value, then the time will be in this direction. If you want to calculate the present value and given the future value, we can calculate the opposite way as well. Next one, say for example, there is a 10% of a discount rate. So earlier we took 20%, which was quite high. So let's come back to a more reasonable interest rate. So 10% interest rate, $100 today is financially equivalent to $133.1 in 3 years. How? Today $100 becomes 110. So 100 times 1.1 is $110. Similarly, now $110 times 1.1 is 121. And again, 1 year further down the line, 121 times 1.1 is $133.1. So this is how, with the time, it compounds, and that is the reason the compounding has massive power, and it increases the number quite significantly. One interesting quote that comes to my mind is Albert Einstein, the physicist, philosopher, and one of the brightest mind to have ever walked on the face of earth. He said that the eighth wonder of the world is power of compounding. It really makes things exponentially big. It makes the number unexpectedly large with the time, depending on the factor or the interest rate, etc. So see, $100 becomes 110, 121, 133, and so on and forth. It can just keep growing with the time. Let's see other way around as well. So the formula here is PV times 1 plus R to the power n is equal to future value. So the PV is the present value times 1 plus R. R is the interest rate. In this case that we calculated, it was 10. And how we write it, it is 1.1 essentially. So present value was $100. 1 plus R is 1 plus 0.1. We write 10% as 0.1 to the power n, which is 3, and that becomes our future value, which is 100 times 1.1 to the power 3, and you'll arrive at the same number as given here. So that is the magic formula to calculate future value. And this is what we did it manually here as well in the previous slide. Moving on. So I think we are good here. Again, 121 times 1.1 becomes 133, which is another way to calculate 100 times 1.1 to the power 3. So either we calculate year-on-year basis to arrive at the third year number, or we can multiply 100 directly by 1.1 to the power 3, and we will get the same number. So that is the power of compounding and way to calculate the future value. So compounding future value, what if we need to discount? That is the question. So we understood how to calculate the future value based on the PV and the interest rate times year. Now we have to do the reverse process, finding out the discounted value. So what we do for that is, another way is we can reverse the formula. So if we want to calculate this PV, we can just transpose. So future value divided by, this will come here, 1 plus R to the power n. This is another way to calculate present value. So future value divide 1 plus R to the power n, and we will get the present value, which means if somebody had given me that value of the cash flow which I'm going to get 3 years from now is, suppose 3 years from now, the value I get is 133.10, and I have to find out what would be the present value of this dollar cash flow in 3 years down the line. So I will divide this value, which is the future value, by 1 plus the interest rate discount factor, which is 10% in this case. So dividing by 10% is how many years? That is 3. That will be 100, because that's what we have already seen, that if we divide 133.1 by 1 to the power 1.1 to the power 3, it will be back to 100, because if we multiply 100 by the same number 1.1 to the power 3, that becomes 133.1. So this is how we can calculate back and forth between the present value and future value if discount rate has been given and the number of years are also given. The next compounding discounting is understood. This is called discount factor. Moving on. This one is interesting. Cash flow. When we have an investment, typically how the project works and the kind of problem that we face for the exams like ACCA or CFA, etc., that there will be initial investment of cash, $1,000, which is given. And then first year, we are lucky, business is running good. We got 400, second year 600, and then 200. It could be a business or it could be a project, because often finance managers are given the projects for appraisal. So how do we calculate? Again, we are going to use 10% as the discount rate. So here, 0.9091 represents the discount factor, which is 1 by 1.1. This one is 1 by 1.1 to the power 2, because this is for second year, right? This is for second year, so to the power 2. Now, third year, the discount factor here we are calculating, it will be 1 divided by 1.1 to the power 3. And it becomes 7.7513. What we do with this now? We have learned in the previous example that we can just multiply the dollar value, the cash value, with the discount factor. And if we do so, we will get a lesser number. For example, almost $360 here, and then some 502 maybe here, so on. We will get, which will be the present value, which means this value will be the value now. So we are calculating the value of all the cash flow in year 0, in now, at the moment. We are living now in the moment. So after we calculate all the cash flow in the present value term, and we sum up, and suppose that we get X value, we compare that X value or adjust that with the initial cash outflow, the investment that we made. So we made the investment, and then we just adjust with the present value of all the inflow or the earning from the project, and then we see whether we have made the money, whether the sum of the two is more than 0 or less than 0. If it is more than 0, good news, because the project or the business have made money. So let's see the number. Interesting. So this 0.9091 becomes 363. So this 363 is the first year value or the value of the first year cash flow discounted by this factor. We get 363. This value becomes 497, and finally 150 for the $200. Sum total is, in this case, if you'll add everything, it will be 1009.77, because when you subtract this cash inflows present value, the present value of this dollar value, this one, that will be 1009.77. Now you adjust this number against the investment that you made in the very first year. You know, every project, every business, every investment requires first investment, and then we see how much money can be made in the future, and all the cash flow inflow basically, or the profit after tax or the cash flow from the project will be discounted in today's term, and then we compare with the investment, and if we get the net number bigger than 0, that's a good news, we made money. Let's see what happens here. So 1000 adjusted against 1009, we made $9.77. That means it's a positive cash flow. So that is a positive NPV, and this project will be accepted because it has made the money. Let's make this scenario a little more complex and see how a more complex example look like, and then we can learn how to calculate IRR. So in this example, essentially we have cash flow for 1, 2, 3, 4, 5, 6 years, and then finally we get the money back. So in this case, what is happening is on 1st January 2017, we made an entry. Entry means we made the investment of to the tune of 290,000. Subsequently, end of the same year, we had cash inflow. That is good news because the project has started to make the money the very first year. And how it is calculated? There is a question. EBIT, that is earning before interest and tax. Before interest and tax. Either it can be given to you in the exam or maybe in real life, or you have to calculate one. Then we also need to adjust the taxes which will be paid. Plus, and when it is paid, we are calling it less, right? Just to keep in mind, when it is being paid, we call it less. When it is added as a cash flow, it is considered plus. Why we are adding D&A, depreciation and amortization? Because it is not a pure cash outflow. It is a fictitious charge, or it is a notional charge that we add in the P&L every year to find out the impact of the wear and tear and the use of the fixed assets or any such valuable assets. So depreciation and asset, it is not the real cash flow, right? So we need to add it back because we are considering only the cash flow when we do the NPV analysis, right? So add D&A, depreciation and amortization, not that D&A that we have learned in biology, not that one. So less cash taxes because that is paid. This is added. Then we also have capital expenditure, because in any business practically we also have to make the investment in the factory, plant, equipment, some capital expenditure in order to stay ahead in the business or to protect the revenue or the market share. So we have to continue investing as well. So what happened with that? It is an expense. So that is an liability. That's an expense. So we subtract that as well. So it is less. Then less changes in net working capital, NWC. So if we increase the level of inventory, if we require to do so, or inventory becomes more expensive in future because of the inflation or any pressure on the supply side, that will consume some extra cash. And that's why we have less, because that is a cash outflow. So cash outflow is a negative number here, and we have to subtract them year on year basis. Now, if we just factor all the plus, minus, less, plus, etc., we will arrive at this number. And what is it? What this is? This is net cash inflow for the year 2017. If it was a negative number, it would result in outflow. We'll consider that as a net cash outflow. But in this case, good news, we have a cash inflow, net cash inflow. Similarly, we can calculate for all the next 4 years, including 2021 December. Of course, we have not arrived at that. Sometimes we also have to make an estimate when we are projecting the cash flow for future couple of years ahead in the time. And finally, the project is completed in 2021. So what happens when the project is completed? Some of the fixtures or the fixed asset investment, they will return some cash back to us. At the time of exit, we might get some cash back to us. So here, this seems to be quite lucky. We got 400,000 as exit. Though we had invested only 290, but we got 400,000. You can imagine, because of the inflation or maybe appreciation of the value of the asset, that could have been higher cash inflow. So that is at the end of 2021. Now, let's do the interesting part, much more interesting part, in fact. So we need to discount each of this cash flow. And since this and these two cash flow are in the same year, we have to discount them with the same factor, same discount factor. So we are not going to have a different factor because it is in the same year at the end of 2021. Now, if we apply a discount rate of 10% only, let's see what happens. 10% discount rate, 1 year. If we discount 1 year, how do we get it? 1 divided by 1.1. We have looked at that in the previous slides. So first year is 1 by 1.1. Second year is 1 divided by 1.1 to the power 2, because it's the second year, right? And the third year similarly is 1 by 1.1 to the power 3. You can do and you can find out. It will come to 75%. And subsequently, it is a fourth year, right? 17, 18, 19, 20. That would be 1 divided by 1.1 to the power 4. And we'll get 68%. Fifth year, similarly, 1 by 1.1 to the power 5. And we get 60%, 62% factor. Now, since we have the discounted factor here, discount factor given, now we will be able to calculate the present value at the rate of 10%. How do we do that? We know we multiply the cash flow with the discount factor and we get the number. So 37K multiplied by 91% is 34. Similarly, dollar value times discount factor, we get the present value at for the second year cash. And all this cash flow represents the value of the cash flow in the future in today's time at year 0. This is at year 0, means what? Today's value. So if I'm getting, say, $100 next year, another $100 2 years later, another $100 3 years later, we have to calculate what that dollar value, each $100 value will mean today. And same dollar value which is coming in future in the subsequent years will start to become much less valuable today. So that's what is applied here. We get the cash, the present value of each cash flow, including the exit value of the project. We calculate everything in the present value, and that will become 106,803, because this one is not discounted, by the way, because it is in current value. It is the value invested today. So we don't discount this one, but everything else is discounted. So what do we do here? How do we get at 106,803? This is basically 290,000 negative value plus 34,000 plus 32,553 plus this value plus this value plus this value, and finally this value. So if we sum up all this and also adjust this, we'll get 106,803. Getting clear? Better? So that is the approach to calculate net present value from the earning. If we have EBIT, net profit, or such number given, we can make the adjustment, get the cash flow for each year, and discount, use a discount factor, appropriate discount factor for the organization, and get the factor, the present value of each cash flow, and finally calculate the net present value. So this reflects that the project is making good money. 106,803. This is pure net cash flow after factoring all the investment and all the present value, etc. Now the next question comes that what is IRR? Internal rate of return. So the answer is the IRR is the rate of interest at which net present value becomes zero. So let's think intuitively. If we applied 10% discount rate, the factor was 91%, or second year 83%. What if we would have selected interest rate of, say, cost of capital, say at 13%, this rate? What would have happened? Let's think. So if we increase the interest rate or discount rate, the present value start to become lower and smaller, because higher the cost of capital or the interest rate means higher the discount factor, discounting process, lower the value of the dollar in today's term. So if we apply present value of 13, of course our net present value will be less, our present value of the each cash flow will start to get lesser. Let's see how. So applying 13% discount rate. So at the first year, very first year, we get 85% factor. See, earlier it was 91% when we applied 10% discount rate. Now it is only 85%. So the cash flow in the for the first year cash, the present value of the first year cash flow is smaller this time. See, only 32,000. Earlier, when we applied discount rate of 10%, we had 34,000 of present value. Now the same cash, we apply the discount factor to the same cash. When you apply 10%, the present value was 32,553. When we applied 13% discount rate in 2 years, the present value of the same cash flow is much lower. It is not 32,000. This time it is 28,000. Similarly, in the future also, the cash inflow start to become smaller and smaller when we apply 13%. Yet, we can see that since this is not factored, this is not discounted, it is present value anyway, because initial investment. So we find out that adding like the initial investment as a cash outflow and add all the present value at the rate of discounted at the rate of 13%, we will get a positive cash flow. Still, it is a positive cash flow. It is 17,544. That means we are still making money. Even if we apply 13% discount rate, we are still making money, but way smaller than when it was 10%. At the 10%, we are making 106,803 total cash. But at the rate of 13%, it is only 17,544. Means when the interest rate is going up, the net present value is getting lower. Now you can see and develop the intuition how the discount rate can lower the net present value or even the present value. Okay, now another extreme example we have to imagine now. Okay, so from 10, when we increase in the discount rate up to 13%, we have almost 18-19% of net present only. What if we increase the discount rate or rate of interest at a much higher level? Say, for example, we increase it from 13% to 21%. What would happen in that case? Let's see. So increasing the discount factor to 21 means our discount rate for the first year itself has become 83%. And not to forget, 83% means here 1 by 1.21. So the discounting is at much lower percentage. And same cash flow, which was 37,000, yeah, after a year it is discounted to 31,302 because of the much higher discount rate. And similarly, second year, third, fourth, and all, every year the value have gone down drastically because of the much higher discount factor. The cost of capital is higher, So the present value will be much lower. Now, if we add, again, this is the entry value, and if we add all the present value of the future cash flow, we finally see that the value is a negative. It is 21,470. Now we arrive at a negative cash flow. Negative net present value means the project is making a loss. After adjusting the initial investment and calculating all the future value at the present worth, because we know a bird in the hand is worth 2 in the bush, or sometimes 3 in the bush. So present value is always much lesser depending on the discount factor. At the 21%, the net cash flow is negative and project is not making a profit. It is in negative in cash, 21,000. That means somewhere here, somewhere between 13% to 21%, we have the hypothetical or maybe a real interest rate at which the net present value will be neither positive nor negative. Somewhere in between 13 to 21%, it will be just 0. And how do we find it out? And what it is called? That's what is called internal rate of return, IRR. Okay, so internal rate of return is somewhere in between, but we need to know how to calculate this, because there are different ways. There are some trial and error method, but that can be quite cumbersome and time consuming, because we exactly don't know what rate to choose and when it becomes 0. So we have to find out a more reliable and smarter way to get that IRR. Okay, so what is the process of doing this? What we do typically to calculate that, we first look at the difference of the interest rate. So the negative, the discount factor which gave us a positive cash flow, and a discount factor that gave us a negative cash flow. What is the difference between the two discount factor? So let me mark it here. In terms of percentage, the difference is 21 minus 13, which is 8%. Okay. Let me clean this. So that we can do better calculations. Okay, so we have to take the difference between the two interest rate, which is 8%. Now we also have to then find out the difference between these two. Of course, we know that when we apply a higher discount rate, it is going to be negative. So the neutral difference between this on the number scale is how much? If we take 17,544, 17,544, and we take subtract the value to take the numerical length. This is how we need to find out IRR. So we need to do 17,544 minus 21, 470, and that would be 39,014. So the numerical difference on the number line, 17,544 to become 0, it will take 17,000, and then to become negative, this is the net difference between the two number. Okay, so 39,014, this much cash has gone down between the two numbers, between the two discount factors. So 39,014 is a net loss between the two percentage. Okay, that's the good news. Now we need to just divide this number by 39,014. So 17,544 by 39,014. Much clearer now. So 17,544 times 39,014 times the difference between the two, which is 8%, times 8%. And let's think intuitively why we are doing this. Because this 17,544 has to become 0. When at the number line, that comes to 0, and then further it goes down to minus 39,014. We have to take a net difference. Sorry, it has to go to it has to become 21 from here, 470. So basically the net difference of 39K is between the two rates, which is 13% and 21%. So we have to find out at what hypothetical percentage this 17,544 will become 0. And to find out the hypothetical rate at which 17,544 this becomes 0, we have to divide this number by the total gap, total flow in fall in the cash flow. So we take this factor, and since this fall has come because of this 8%, so we will just take a proportion of 8% in order to know the IRR. So if you do this, you'll find out the 8% times this number is 3.6%. Now, what does that mean? That means that if we just increase the interest rate, or we just add more interest on 13, there will be approximate 3.6% we have to add at the rate which the entire NPV will become 0. That means we had 13% at which the NPV was positive, but if we just increase it by this number 3.6%, which is 16.6%, entire NPV will become 0. And that's what is the IRR. So IRR in this case is 16.6%. And at that IRR, you'll find an NPV becoming 0. So hope you understood this. And in case of any question, you can let us know or drop a comment on the YouTube channel, or you can connect to, or you can send an email on connect@finsapient.com, and keep watching our videos for more such updates, calculations, and business and financial matters. Thank you so much for watching the video. Thank you.